Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm back on Twitter, looking at the information from Twitter. I'll give you my financial opinion about some of the information I'm seeing off of Twitter. It's usually commodity related, so I talk about commodities for the most part. So this will be about information from Twitter about commodities and precious metals. So if you want to follow me on Twitter, just to give you guys a heads up, it's at finding_finance. If you want to follow me, I'll zoom in just a little bit so you guys can see this a little bit easier. There it is. And we'll get right into it. So this is what I'm sharing on Twitter. Again, this is platinum. Another 4% gone from platinum COMEX inventories today. The total inventory is down below 250,000. It peaked over 800,000 in 2021. So we're really eating through this inventory quite rapidly. You can see 250,000 or so, and it was 800 in 2021. So that's a pretty good chunk of inventory that's been removed. I am still very much long in platinum. I am long in silver. I'm also long in gold, just not as heavily as platinum and silver. I think platinum provides the best value on a ratio perspective against any other metal. That is the one that I am watching and have been accumulating amounts in. It has gone up about $100 an ounce recently, and I've been accumulating less as it gets more expensive. That's how I play these markets. Looking at oil, this is from Jay Hinster. It says this would be my second buy for the oil. Stop below 87. I'm not trading any of this stuff, guys. I am long oil. I think that anywhere in this general vicinity over here, where it was high and started to come back down, that there was strategic petroleum reserve releases in there. And I think eventually we are going to work our way higher, break out of this descending wedge pattern, and go up. And I think we're going to break 128, and we're going to go past the moon at 132, and we're going to go way higher than that. So that is my opinion. I think that the world is in an energy crisis, and I know I say that a lot. And a lot of these oil, let's say, is a substitute for natural gas. Coal is a substitute for natural gas, and I think we're going to extend nuclear power plants. I think uranium is going to get in a big squeeze. I think anything energy related is going to get in a squeeze, and we will be squeezing these things after we have the lowest level of inventories worldwide, and we're at pumping capacity. We've never seen this before. And I don't rule out ridiculous numbers in terms of oil prices, because I don't know where this thing's going to stop. And that goes for natural gas, oil, for all of them. And I don't know where uranium is going to stop going up either. Here's Fuel Cell. Fuel Cell's it's a hydrogen company. And he's got a nice little chart here. I do own some in it. This is a shoulder hedge shoulder, and it's a small speculative company. I do not own very much, but it does look pretty enticing, this bottoming type pattern that we're seeing in Fuel Cell. Here's uranium, the top 10 uranium stock percent gains in the last month. LEU at the top there, and in fact, that was one of the picks on the Platinum membership. In the description link below is the website. It was one of our top picks, was LEU. UEXCF, DYLLF, that's another one I like, Deep Yellow. I also like Encore Energy, and these are kind of the ones that I like that have performed well over the past month. Now, I'm not trading in and out of these companies. I am buying them, adding to them when they're low, like Encore and Deep Yellow and Centrus and some other ones. And I'm waiting for them to appreciate throughout the bull market. So in all honesty, I don't really care about the month to month. I don't care about the short-term news. I care about the big picture, the big structural changes happening in the markets. It's got to be kind of macro related. And when you look at commodities in general, it does look like they could potentially go higher as a whole. So they are turning around, and it looks a lot better. And hopefully that momentum can continue. I always say that. I'm seeing so many SPX charts being compared to 2008 and how we are about to crash. If everyone sees it, and usually when everyone sees it, it does the opposite. That's usually what he's, that's what he's referring to. Here's the CRB index. I thought this was a really good chart. Go, John. Owner of commodity will be next king of currency. So this is the long CRB. It means long oil. I agree with that. I am very much long oil, natural gas, uranium. I'm long everything that's commodity related and energy related. Energy and commodity related, I'm in it. Energy service companies, all that stuff. But here's what he did is he took this line here, probably projected it up, put that up there, and we broke out. We did a retest. And what do we do on those retests, guys? Everyone knows this on the channel and on the website. We buy the retest. And we've been buying this retest here. And we could do a little bit of a moonshot. And I think we're going way higher than 480, where the moon's at. It's going to go far higher than that. Because I think the conditions are much worse, better for commodities, much worse for the economy than in history. I think that we're going to hit an energy constraint worldwide, not just the United States in like the 1970s, where we had massive moves higher in energy and precious metals. That was America constrained oil. That was constrained to only America. Now, this is a worldwide. This is worldwide. Inflation's happening worldwide. Commodities are going to be tight worldwide, and so is energy. There's no spare capacity in this system. I think we're going to see some ridiculous stuff. And inflation's going to be ridiculous. So I think that the play here, in my opinion, is definitely energy, an energy play, and precious metals, because currencies are going to have problems when you have an energy constraint, much like the 1970s. That's my take on it. Looking at this, we says we're all just lucky being here at this point in time. Really looking the right way, having the knowledge, knowing what to buy, seeing the future, and executing it well. What he's talking about is this GDX to GLD. GDX is pulled back against GLD, and we're at that 61.8% retracement level. In Fibonacci sequences, 61.8 comes up a lot in pullbacks. And right now, we're at that kind of pullback level on the ratio chart here, signaling that we should be looking at some of these gold and silver mining companies like GDX, which is the ETF, as a rough indicator of what that is doing. You can also see a low, a higher low, and then a higher low if we can hold it right where it's at that support level. So that's that there. Looking at this, we've got, I know you're a big Bannerman fan. Me too. It's a big position of mine. So I wanted to pick your brain. Are you not worried about the market cap in November of 21 was as high as the last bull run top? This is the market cap. And I know people, they talk about market cap. They get afraid. Oh, no, it's the same market cap. But what I do and what the name of my channel is finding value. You're looking at market cap. Market cap is not value. That is just the size of the company. And I know that Scott replied to this, so I'm going to click and use Scott's response because he has a good response. He says, not at all. They only had 27 million pounds in 2008. And now we have 10 times that amount at 270 million. Probably one of the best developers out there. So they have 10 times the amount of uranium, and their market cap is the same. This peak here. Well, if they've got 10 times the value, if we were to peak again, it should be 10x what this is. It shouldn't be 500, whatever this unit of measure is. I think it's 500 million. It should be 10x that, 5 billion. And we've pulled on back down to 300 million or so. So there's that. Touching on that. So this is a First Majestic Silver versus XAG. Basically, it's bullish for First Majestic versus silver price. If we get the top of the cylinder AG, it'll do 3.5 times the performance of silver. What he's saying is First Majestic is highly valuable down here, and I agree with that. I very much agree with that. It is in fact one of the companies that I am accumulating in. Coming on down, it says energy prices in Europe. This is Dutch edition. This is Dutch natural gas futures up by a factor of 10 in less than 24 months. We broke out of this price-contained area and have gone ballistic. You've got the three waves, kind of that bullish, maybe increasing cylinder, and then we get the big move after it. Is this a Livermore cylinder? Maybe. I see this pattern here in uranium stocks. I see this pattern in natural gas stocks. I see this pattern in oil stocks, where we're right here. That is where the pattern is. I even see it in some lithium stocks. And I've been buying this bottom here, hoping that this comes after. The market conditions are ripe for that to happen. And the yields and money flows are also ripe for this to happen. And it's already happening in natural gas. So I think that that's going to happen in American natural gas companies where they've got the three humps like this. We're down here. And I think we can have a pretty big move. And in fact, what I'll do is I'll pull that up to show you guys what the natural gas chart looks like. And you guys can see it yourself. So when I'm talking about is this one hump, two hump, three hump, it pulls on back and then we launch. Now we've got one hump, two hump. Now we've got the third hump here. We got this pullback. Is this as far back as it's going to pull back? It could pull all the way back here. I'm not exactly sure. I don't know the future. Everyone will say, oh, technically it's going to fall. I wouldn't use that as a guide. What I've been doing is I've been taking the approach and I bought down here. I bought down here at the bottom. I buy down here at the bottom. I buy down here. Every turning point that you see kind of a trend line break, I'm buying it, guys. I don't really care. You know, you buy it cheap, you buy it on the break. You buy it on the break. You buy it in all these areas. And that's where you accumulate. And what I'm waiting for is that big move higher. Now, are we going to make the move from here? Or are we going to make the move where this comes back down and then we make a move higher? I think what's going to happen is we're going to just jet on higher. Or we'll have a small little pullback here, then we'll jet. I don't think we're going to go and do a full retest anymore. The sellers had their chance to really kill this thing lower, and they have not done that yet. Could it still be out there? It still could. You know, I could be wrong. And in the short term, it is the least predictable. But long-term wise, guys, here's your 1, 2, 3. That is your 1, 2, 3, your pullback. That pullback could have been this guy right there. And now we're heading higher. But I remain open. I could be wrong there. It could do something different than what I am expecting. This was back in Weimar, Germany. Platinum did a 1,700x, its pre-war prices. The ratio of platinum in Weimar, Germany to gold, the platinum to gold ratio was 6 times as expensive. So 1 ounce of platinum could buy 6 ounces of gold. Platinum actually outperformed gold in the inflationary or in the hyperinflation back in Weimar. Pretty awesome to know that. So platinum is a superior inflation hedge. This is first time viewing, listening to the podcast. Thoroughly enjoyed it. That's with myself, I guess. Just wanted to put that in there. Downtrend is broken with the back test. This is pretty awesome. We saw that with John's one there as well. So he took this one, put it up, projected it up, and we've broken to the upside. Now, a lot of people, what they do, and I don't do this, I look at ratios and market conditions. If we're still cheap, they'll say, oh, this is going to break back down and come back to the bottom here. I'm like, well, I look at different metrics. Those metrics is the expansion phase of real estate. I look at that. I also look at ratios, which tells you relative value, which is still very cheap, even though we're up here. And I look at interest rates. If the interest rates are continuing to decline, if we still have inflation, if we still have the housing market being somewhat strong, I know it's weakening. I get it. I understand that. But it doesn't mean it's out for the count. We got to see inventory still increase. And it's still bullish for this to go higher. So I've been long, and a lot of people said this was going to go lower. I don't listen to them. I listen to my own thinking. Nat gas is about to take new highs right when everyone thought inflation was over. Yeah, everybody thinks inflation's over. This thing could go and make new highs here any second. The Freeport LNG terminal is coming back, and that's going to have an impact on natural gas prices. People are front running that coming back. It's coming back online in October, 100%. And what I mean by 100%, 100% capacity is coming back. And this could go much higher. And I thought we could maybe get a fall pullback, but with the news coming out with the Freeport LNG coming back online, we may not get that pullback, unfortunately. We've got Willis. The talking heads have been transfixed with what the US dollar index is doing. This has been the real story. And what he did is he took the DXY and divided it by the PPI, the producer price index, with relationship to all commodities. And what's happening is we're seeing the DXY lose purchasing power against the producer price index. So he's basically inflation adjusting the DXY. And it's declining even in the short term of 2021 into 2022. It's still declining. Here's the platinum gold that was at 6 times price. That's the 6x. Well, it's almost 6x. It's 500 and something percent. But it's almost 6 times the price of gold in that hyperinflation in 2022, 2023, in that, the 1920s. And one cool thing that I noticed here is I just threw some trend lines on it. And I've got that same gigantic pattern here for Germany. This is platinum priced in gold for Germany. Well, it's just a ratio. It's a ratio. I don't think it matters that it's in Germany, but I guess it would be in the German currency. We are very low here, and I don't know where it is in German currency. It's probably similar to ours right now, which is 0.5 or 50% in this. So we're down here very cheap, and I think this is going to break to the upside. If we can break this downtrend line at about 100, a ratio of 1, if we can break above 1, I think we're going to see a big move in platinum. A big move. And that last time we broke 1 was right here, and we saw that big, gigantic move. I think we're going to see a super spike in platinum against gold at some point in the future once we break out of this simple chart here. And this is the current platinum to gold ratio. It's 0.53. It's super cheap. We've broken out of the upper trend line here, and I think we're going to head higher at any second here. So that looks good. Scrolling down here, I've got the big picture view and the short-term view both look good to me. And I just got the first wave, the second wave down, and the third wave. We could be finishing this wave 2 here before a next move much higher on the CRB to S&P 500. This is kind of zoomed in. We've been consolidating in this descending wedge pattern. And remember, this pattern can change as new data points are added into it, but we could break here at any second to the upside and start a new trend where the CRB outperforms the S&P 500. That could be a combination of things, though. We could have the CRB index go up at a faster pace than the S&P, with the CRB remaining flat and the S&P 500 going down. That would be an outperformance. Or what I expect to happen is the CRB index to go up while the S&P 500 goes down in an increasing interest rate environment with higher inflation. So that's what I'm expecting. Hopefully that's the case. You can obviously watch me. I did a interview with Scott and Steve at Sow and Reap Capital. So you can watch that as well. We've got a couple of these commodities are starting to look kind of tasty here, I would call it. Tin's really bottomed. It looks like it wants to come back higher. That's why we're seeing the rate of descent basically come to 0 here. So the buyers are equaling the sellers. I call it the sellers are getting tired here. Buyers, your turn now. Let's turn this thing up higher. We've got nuclear. Nuclear's been squeezing up here. We could see a move at any point to the upside. We know natural gas is going vertical. We know that they're extending nuclear power plants, and they need physical uranium. So it's squeezing up. What's it going to do here? I think we're going to break to the upside. That's my inclination here. We also see the sideways movement, the pop higher. Then we get a little sideways movement after, and then we get a break usually. That's a pattern. This is the natural gas that I'm talking about. It's rocketing higher here. This will slow down, I think, when that Freeport LNG terminal comes back up. So I think the rate of ascent will slow down, and I think this rate of ascent will be transferred to the Henry Hub natural gas price. This will relax and go kind of flat, while the Henry Hub starts to go ballistic to the upside. when that LNG terminal comes back up. And we could see movements before that LNG terminal comes back up. And here's UK natural gas. It's also going up quite dramatically over these past few months. I can't imagine what's going to happen in wintertime. I can't imagine. My assumption here is the BLS government is likely looking at a per unit measure. This makes sense for something like apples, but not at all for a mandatory expense like insurance or whatever else. It says basically if your home goes up 20% and your insurance goes up 20%, they would say insurance costs haven't increased. And that's what's funky about these measurements that they use is they do these hedonic adjustments and substitution adjustments where they adjust the price of something. Oh, your home goes up 20% and your insurance goes up 20%. Well, that's okay because you're insuring the same value per unit of measure of home. And I think that is a little bit ridiculous because what they're doing is they're massively understating the effects of inflation in the system. Welcome to the Energy Cliff. This is from SR Rocco Report. With the world losing between 10 and 11 million barrels of oil production each year to the high annual decline rate. And what's happening here is we've got to find 10 or 11 million barrels per day of oil production every single year to stay flat. What the problem is we're not finding that. We are not finding anything near that. And I don't think that the production that we're at is sustainable for a very long time. So I do think that we're going to have the decline rates around the world put pressures on oil production volumes over time. And that production decline will be felt. It's going to have profound impacts on everything. And that's why I'm long energy and precious metals. And the reason I focus on those two is if you have an energy crisis, the debt by its design has to grow exponentially. But the GDP is directly tied to your energy production. And if you can't grow energy production, you will decline your GDP at the same time that you must grow your debt. And what that means is that your debt will fail because you don't have an accompanying GDP growth to pay your debt off. Your debt will implode because there's no way to support the amount of goods in the system in relationship to the amount of debt in the system. So what that means is you're going to go into a hyperinflation if you continue to add the debt into the system with no accompanying service or goods. It's a lopsided move. So what's happening is I think we're hitting those limits and constraints in the design of the currency system. That's what's going to happen. So physical gold, physical silver, physical platinum, much like the hyperinflation in Weimar Germany that I'm trying to share with everybody, where it went from a very low ratio all the way to almost 6 during the Weimar hyperinflation. If those same ingredients are added in this mix where we have constrained energy and a unrestrained debt growth, platinum, at least historically in Germany and some of these other hyperinflations, have outperformed gold and silver when looking backwards. So I'm a big platinum bull. It's also the cheapest in relationship to the other metals on a ratio perspective, given history. So I very, very much like platinum. Also, if you look at it, everyone owns gold and silver. It's very liquid. And platinum is illiquid. And some people say, well, that's a bad thing. It's not a bad thing if everyone's trying to buy it and there's nothing there, because that means that the price is going to have to absorb all of its demand. And platinum's used in a lot of things in industry, and so is silver. So I'm very much skewed to the metals that bring value to industry, which is silver and platinum, and palladium as well. Food price inflation in Germany reached 15%. So on top of crazy electricity and heating prices, they have to deal with that. This is a big breakout. You could draw a line, a trend line right on the top of this, or coming slightly lower like that, and we've broken to the upside. You're probably going to see these things go vertical, guys. Protect yourself. Protect yourself with physical metals. And you know, I care about my viewers, and that's one thing that I'm doing is protecting myself in case of hyperinflation or large inflation numbers. What we really need is a cost of living index. CPI in the 70s and 80s roughly was a cost of living index. After dozens of changes, it no longer resembles anything of the sort. It's just a vague general price index that shouldn't be compared to things like wages. And I agree with that. They can adjust it whichever way they want. This is gold and silver ratio. We basically have broken to the downside, did a retest move or a back test, and now we're heading lower. So that means it's bullish for silver as this ratio goes lower. And I'm a big precious metals bulls guy. I mean, the physical metals is where I'm a big bull. I am a huge bull of the physical metals because there's no counterparty risk. It's not playing a margins game like you are playing in the companies. So I just want to de-risk everything, get physical metals, and it's like I'm good. I just feel happy and I'll say secure with that. But that's what I've got for today, guys. Hopefully this you got a bunch of different information. I've kind of thrown my financial opinions on top of it. That's what I think when I look at these posts, and hopefully you enjoyed it. If you guys enjoy my, we'll call it my viewpoints, give me a thumbs up, subscribe to the channel, subscribe to the website below, the Platinum membership if you want to know how to play this. I give a lot of good ideas on companies, very leveraged companies, I should say, to the price moves of these commodities. I think we get pretty good buy points and cost average in points. And there's a lot of information on the website as well if you want to further your investment education. All right, guys, we'll catch you next time. This is Finding Value.